Look at your screen right now. If you are long the euro, you are standing on a trapdoor, and the hinges are already creaking. We are trading at 1.1612, and the market is not pulling back. It is coiling for the kind of expansion that clears out stop losses in seconds. Most traders see a deeply oversold reading and want to buy the dip. That is the trap. There is one danger zone, a hidden opportunity, and a single price that invalidates everything. I'll show you all three. Stay until the end. I'm giving out 3 exact entry and exit levels you can execute on immediately. Here is your instant market verdict. The session bias is trending with extreme bearish momentum. We are not fading this. We are looking for structure to break lower or for a very specific counter-trend scalping level, but do not be fooled by the low RSI. The hierarchy of timeframes is aligned into something we rarely see: a clean strong sell on the weekly, a strong sell on the daily, a strong sell on the 4-hour, and a strong sell on the 60-minute chart. There is zero bullish divergence on any actionable timeframe. The invalidation level that proves this bearish thesis wrong is 1.1694. Write that number down. 1.1694. If we see a 4-hour candle close above that pivot, the structure shifts, shorts cover, and we enter a mean reversion environment. Until then, it is sell rallies or sell breakdowns. Do not get cute. Let's walk the charts because this technical formation is a rare alignment. We start on the weekly. Zooming out to see the forest. The weekly candle has sliced through the MA20 at 1.1701 and the MA100 at 1.1702 like they did not exist. We are now trading below the MA50 at 1.1649. This is a massive rejection from the 200-week sentiment zone. The MACD on the weekly is firmly negative at -0.000 and expanding, confirming that this is not a short-term squall. This is a regime shift in momentum. The narrative is clear. The weekly chart is repricing the euro lower against a basket of global risk. Dropping down to the daily timeframe, the damage is even more visceral. The price action is trapped beneath every major moving average we track. The MA5 is rolling over aggressively at 1.1635, the MA10 is at 1.1692, and the MA200 is sitting right here at 1.1683, acting like a brick wall. This is what we call a death framework. The short-term averages are stacked below the long-term averages, and price is struggling to even touch the shortest average. The daily MACD is driving deeper into negative territory with no signs of a histogram contraction. The RSI is at 41, and here is what most traders miss. In a strong trending environment, the RSI can spend a long time in the oversold gutter. Do not buy just because the needle looks low. Buyers are exhausted, and this is the trap we identified. Now we go down to the execution timeframes, the 4-hour and the 60-minute. On the 4-hour, the moving averages are in full bearish fan formation. The MA20 is far above price at 1.1701, and every minor rally is being swatted down by the MA5. We see a series of lower highs and lower lows, classic continuation structure. The MACD on the 4-hour is negative divergence neutral, meaning it's not fighting the drop, it's confirming it. We are inside a descending channel, and the top of that channel aligns almost perfectly with your key resistance at 1.1674. On the 60-minute chart, the volume profile shows a low volume node between 1.1620 and current price, suggesting we are in a vacuum that can accelerate violently. Your support floor is clearly defined. 1.1588 is the immediate swing low. Below that, 1.1568 is the secondary target. If you are looking at your charts, draw a horizontal line at 1.1588. That is the line in the sand. Let's connect the fundamentals to this technical carnage. The 24-hour core news flow has been oddly quiet on the surface, but the silence from the European Central Bank is the real story. The market has aggressively priced in a dovish ECB while the Federal Reserve maintains a hawkish hold. The euro to US dollar outlook here is driven by a widening interest rate differential. We are seeing the US dollar index squeeze higher, and the euro has broken its correlation with risk on flows. It is acting purely as a funding currency right now. There was no specific ECB speaker to rescue the single currency overnight, and that absence allowed the algo-driven selling to accelerate. The narrative that a breakout toward 1.20 is closer than the market thinks is actually an article that exists right now, and it is creating the perfect sentiment trap. When you see headlines calling for 1.20 while price is hugging 1.16, you must follow the order flow, not the narrative. The 1 to 2 week directional lean is a grind down toward the 1.1500 handle, driven by the dollar strength against the euro. The event that invalidates this macro thesis is a hard CPI miss in the US or a sudden verbal intervention on currency weakness by the ECB. If we see a daily close back above the MA200 at 1.1683, the dialogue changes, but that is an uphill battle for bulls. Now, this is where money is made. Most people will skip this because they want a quick signal, but if you stay with me for the next few minutes, I am going to give you the architecture of the session. Here are your 3 trade setups. Strategy number 1, the sniper. This is the conservative, high probability setup. You are waiting for the break. Do not enter now. The trigger condition is a 15-minute candle close below the 1.1588 support level. You need confirmation, no wicks, no false breaks. We want a decisive body close below 1.1585 to be safe. When that happens, the stop loss is placed at 1.1625. The logic for the stop is a re-entry into the broken support zone, which would signal a bear trap and negate the momentum. Your target one is 1.1568, giving you a tight but solid risk-reward profile. If momentum accelerates, target 2 is 1.1540, where you start scaling out heavily. This setup is voided if we see a sharp reversal candle back above 1.1600 within 30 minutes of the break. Patience is the edge here. Strategy number 2, the active trader. This is your standard session plan. We are fading the mean reversion to the moving average resistance. Your entry condition is a pullback into the 1.1640 to 1.1650 zone. We are looking for price to kiss the underside of the 60-minute MA5 or MA50 dynamic resistance, which coincides with a prior minor swing low now acting as resistance. Place your stop loss at 1.1675, just above the structural resistance of 1.1674 and the MA200. The reasoning is clear. If price gets above that wall, the short is invalid. Target 1 is a retest of the session low at 1.1610. Once target 1 is hit, immediately move your stop loss to break even. Target 2 is the 1.1588 support. We are capturing the continuation of the trend without chasing the low. The trailing stop rule here is to move the stop to just above each newly formed 15-minute swing high as the price grinds lower. Let's see how aligned we are. Type your euro to US dollar low for tomorrow in the comments right now. I'm reading them, and I want to see who has the balls to call a number below 1.15. Strategy number 3, the aggressor. This is only for those who know how to lose small and manage risk aggressively. This is a counter-trend momentum fade on exhaustion. Your entry is a limit order to go long at 1.1569. Why 1.1569? That is a liquidity pool just below the secondary support of 1.1568, designed to catch the stop run before the snapback. This is a high-risk play for a technical bounce. The stop loss is excruciatingly tight at 1.1555. If it breaks there, you are wrong, get out. The take profit is 1.1615, a direct retest of current price acting as a reclaimed level. This is a rapid scalping operation against the dominant trend, and you must not marry the position. The explicit warning: the weekly and daily charts are screaming sell. You are trying to catch a falling knife with a high-speed scalpel. Only do this if you have a strict risk protocol. Here is your risk management pulse. Never risk more than 1 to 2% per trade. No positions through high-impact US session news. Stops are non-negotiable. A limit order without a stop is an account blow-up waiting to happen as we close out. The most critical level for the next session is 1.1588. This is the glass floor. A smash through there with volume opens the trapdoor to 1.1500. Tomorrow, we are focusing on the US dollar index and the S&P 500 correlation fracture. That video is live now and it is the perfect sequel to this euro analysis. Check the end screen to understand if the dollar breakout is real or a head fake. Smash the like button if this analysis gave you a clear plan. Subscribe and hit the bell to make sure you never miss a breakdown across all 8 key assets. I'll see you in the next one.